We're going to look at some awesome end-of-year trades in this webinar today, and we're going to talk about doing less to make more. How many of you would like to do more work? Probably not very many of you, right? I mean, imagine in your mind right now a construction site. And one guy at the construction site has been told, two people at the construction site have been told to move a bunch of rocks over to one other end of the construction site. And so one guy is just lifting enormous rocks up into his arms and walking them over to the other side of the construction site. So that's guy number one, lifting huge rocks into his arms and moving them. And then gal number two is pulling up a truck and loading the rocks in the truck and driving them over to the other end of the construction site. Which one of these individuals is working harder? I mean, it's totally obvious, right? I mean, which one of these? Guy number one is working harder. And I don't know why it is, but there's this thing going around that, and I see it all the time. I see it even on, like, The Rock's Instagram feed. Constantly, Dwayne Johnson is, like, preaching about hard work, that hard work gets you everywhere, and he's gotten where he is by putting in more work and outworking his opponents and whatever else. I'll tell you what, Dwayne Johnson was famous for wrestling, and he's huge, and he's super charismatic. And so you could work just as hard as Dwayne Johnson, and you're not going to make as much money or be as famous as Dwayne Johnson. There are other elements in it besides hard work. And I think sometimes we get confused about success, and we assume that some of these same old stupid platitudes that we hear all the time about working harder and all that kind of stuff will make some big difference. Now, some of you one guy, Jim, is saying he can't see my screen, so I'm going to unshare my screen and reshare. There you go, Jim. All right, everybody, can you see the screen okay? Jim H., can you see it all right? Make sure, Jim, you let me know that you can. It's important to me that you can see the screen. And, yeah, all right, everybody says they could see it. Fine, great. All right, so we're going to look at some awesome end-of-year trades, some really big trades that don't take you very long to find and that will make a big difference in your account. I like what I just heard from Greg a minute ago. Decide what you like and just stick to it, damn it. Like, don't keep changing what you do. I think that's really great. Also, it's very nice to meet you. My name is Rob. Some of you don't know who I am, so I'm just going to introduce myself to you a little bit. I live in Arizona. I've been a trader for 15 years. I do a podcast, as was mentioned just a moment ago. Lots of people that trade or that teach you how to trade or whatever are really into Lamborghinis or showing you fancy stuff or whatever. I'd love to be your friend on Instagram, by the way. We could follow each other. I'm just Rob Booker on Instagram. And what I do with my time and my money, because I'm a trader, is I spend time with my children and my family. And it's all I really care about. I don't care about buying fancy stuff. I don't care about, whatever. I went to the mountains and we went camping with my kids. And I spend time with my beautiful partner, and we take our kids all over the place, and we do trips and all kinds of stuff like that. And I think about experiences, not about buying stuff. And I get the feeling that a lot of you here have as your the most important things in your life are not things, they're people. And the reason that you're trading is to take care of those people. And that is absolutely that is absolutely the case with me. And that's the reason that I trade, is to take care of my family and to be good to the people that I love. That's me jumping up in the air into the swimming pool. I just like to have a good time, and sometimes I wear myself out. In case you think that I lead some kind of luxurious life, that's me unloading hay for the horses. I trade to take care of my family and the people that I love. And I get the feeling that that's the reason that you trade as well. I get the feeling that what you want to do is have a better quality of life for the people that are close to you. And I hope that in some way today I can help you do that. I'd love to encourage you to stay in touch. If you go to robbooker.com, you can get on the email list, and you'll get a great email every day called the 5 Things You Need to Know Today email. And I'll keep you updated on trades and all kinds of other stuff that you need to know about for the day. Also, there's a free trades app that we built inside the iOS App Store or on Google Play. I'll show you what that looks like. If you search for Rob Booker Trades in Google Play or in the App Store, you'll see this right here. You'll see that, my little face with my beard, and it's called Rob Booker Trades. And what you'll get is just a feed of all the things I'm looking at in the market or things that I think that you might want to take a look at, and it'll send a little alert or a pop-up alert to you on your phone, and you could stay updated on some really great trades and a bunch of other stuff, and it's completely free, and you'll get 1 or 2 or 3 updates during the day, sometimes a few more, and that's absolutely free. It never costs anything for you to get that. So I'm sure that some of you will be interested in that. Before we get started, I just want to remind you about the one rule. I talk about this in every single presentation that I make. I talk about the one rule. And that one rule is not to let a loss get out of control. Don't let a small loss that's manageable become a giant, horrific pain in the butt. This is true of just a lot of stuff. The other day when I got sick, I went straight to the urgent care facility and I got shot up with some medicine and I got an IV so that the situation didn't get out of control. And if it gets out of control for me, I get really sick because I exhaust myself and then I got to be in the hospital or whatever. So I cut it off early and I made sure I took care of it. This applies to all kinds of aspects of our life, but in particular, it really applies to trading. All of us, if we could reverse the most significant loss we ever took, we would be in a significantly better financial situation. I'll repeat it again. If you could get back your 5 worst trades, you'd be in a spectacular situation. And I want to talk to you just before we begin anything about that first rule, that if you want to be successful, you could just make sure that you never lose more than 1 to 3% of your total trading capital on a robot trade or a discretionary trade. And I'm going to tell you that sometimes it gets worse than that for all of us. I mean, honestly, I know that it gets worse than that for some of us sometimes. But try to contain your losses, and don't try to draft a lot of other trading rules. Don't try to build lots of rules or elaborate plans or complexity. Just keep this rule in mind when you're trading, and you're going to be ahead of the game, and you're going to be ahead of most people. Most people don't stop their losing trades and don't cut them off, and that's why most people aren't successful at trading. Now, there's other rules in between the first rule and the 5th rule, but I just want to share the 5th rule with you today because it's of particular importance today. The 5th rule of trading for me and my group of traders is that 80% of your trading profits are going to come from 20% of the work that you do. That's the 80-20 rule. Some of you are already familiar with that. You could also reduce it even further by continually whittling down that 80-20 rule, and you could say that 51% of your profits are going to come from about 1% of the work that you do. And what I mean by that is that most traders waste enormous amounts of time. And they waste time sitting in front of the charts, chasing after trades that aren't ready, trading counter-trend trades before the end of the week, and we'll talk about that in a minute, trying new stuff that doesn't matter and won't help, buying lots of books, buying lots of courses, buying expensive stuff, and none of it ends up mattering, and it's a frustrating process, and we find ourselves sort of sitting down later on and saying, man, I did a lot of work to really get not very far, and this is true of me as well. When I first started trading in the year 2000, I was $150,000 in debt. My business partner had fled to South America. I had tax debt, I had business debt, I had angry clients, and I had a choice. I could declare bankruptcy, and I could legally absolve myself of my obligations to repay the people who had been injured, or I could try to make a lot of money within a short period of time to make it right. So I called a friend in San Francisco that worked at Bear Stearns, and I said, I'm interested in trading. I've always been interested in the financial markets. And they said, don't be a currency trader. Don't get involved in foreign exchange. It's a rat's nest. You're going to be entering the lion's den, and you're never going to get out alive. And, of course, that's exactly what I did. And I got really lucky. Honestly, I got super lucky. I found a trick. I exploited it. I wrote about it in the book Adventures of a Currency Trader. I made a bunch of money. I paid everybody back. I got myself on solid financial footing. And over the next 12, 13 years, I tried to repeatedly simplify what I was doing. And one of the greatest disciplines that I developed as a trader is the discipline to ignore much of what I was hearing, reading, and seeing about the markets and just stay on my plan. So I want to talk about the 1% or the 0.8% that really matters. today, and I want to show you a bunch of trades. Once again, what I mean by this 0.8% that matters is that most of what we look at or do doesn't matter, and most of us think of trading as a hobby. And when you think of trading as a hobby, you can't stop looking at it, and it's super interesting, and you're always buying stuff to support your hobby. I steal this quote from my friend Matt Lococo. I don't like to think about myself as a trader. I'm just doing this for the money. This is just a job, and as soon as it becomes something that you love so much you could never imagine doing without it, something's gone terribly wrong. This is a job, and what you want to do is you want to make money from it, and then you want to move on to doing something else. If trading is a hobby or something that you just love so much you can't believe it, that's going to lead to some problems, because we don't do better when we do more work. That hard work analogy comes to mind again. Don't be the guy picking up all the rocks at the construction site. You might really love rocks and you might really love construction, but that's not going to get you anywhere. What you want to do is if you want to make the biggest and most significant positive difference in your trading right now and immediately, and you want that change to last, you should reduce your trade size. I can introduce you to 1,400 people in my chat room who would agree with me on this and who have had a revolution in their trading and a massive epiphany as they have reduced their trade size and they have had more success. They make less money, but they make it more consistently, and they don't blow up their account. If you want to have an immediate and lasting impact on your trading that is positive and will put you into the ranks of the professionals, reduce your trade size. And I mean reduce it to the point where it feels like it's demo trading or paper trading. That's hard for us to do, and as long as you want to fight it, that's fine. I'm not your boss. I'm not your mom. I'm not your grandpa. I don't really care. I mean, it's not going to change my life one way or the other if you reduce your trade size, but it certainly will change yours. And you have freedom of choice. We live in a free world most of the time. And you can do whatever you want. I'm not here to just preach to you and tell you that you're an idiot. I'm not here for that. I believe in you doing things your own way, and you are entitled to your own opinion. But I will say it to you over and over again. I have never met a trader who was unsuccessful, who was not able to turn pro by reducing their trade size. I will say it again. Every single person I met that was unsuccessful, that took this advice, began to trade successfully, consistently, and for a long time. Small trade size. So far down that you're not making very much money. Now that may sound like a total downer. I can't make it a positive thing emotionally, but making money is amazing, and it compounds really fast. The second thing that you can do is you can look for the really big trades. That's another thing that you can do right now, is start being more selective about the trades that you look at, and we're going to spend the majority of this presentation looking at the big end of your trades. And then last of all, if none of this makes any sense because I'm high as a kite on Fenergan or whatever, then you can stay in touch with me. Just go to robbooker.com and plug in your good old email address into the box there. And I'll stay in touch with you by email. Most of what I do is free. Some of what I do costs money, but never very much. Everything that I teach costs about $27. So it's not very expensive. I'm here for you. I make my money trading, and I hope that you can as well. I do a report every week on Thursday and Friday of every week for my membership website called TFL365.com. And that membership website now has, like I said, about 1,400 members. And I do what is called the end of week report. And the end of week report looks through a bunch of trades that are ready to fire off at the end of the week. The end of the week is when counter trend moves are more likely to be successful. We live in a world where at the end of the week, traders begin to take profit on Thursday and Friday. They clear out their trades, and then on Monday the trend resumes, and then on Thursday and Friday they get out of their trades again, and the trend is stopped. I don't know why that phenomenon works, but it works incredibly well, and it has reduced much of our trading, discretionary trading anyway, to the very end of the week. That end of the week report leads us into my presentation for today. At the end of a month or at the end of a week or even at the end of a year, we are more likely to see big moves which move in the opposite direction that we have been moving. That's true of almost every single financial instrument that exists. Today you're looking at the US dollar Brazilian real. I know none of you look at this on a regular basis, and I wouldn't expect you to. It's a currency that nobody looks at. But look at this trajectory over the past year to 2 years to 3 years. The Brazilian real has lost 54% of its value over the past 2.5 or 3 years. But at the end of every year, there is at least a slight retracement. And it doesn't have to be very big for there to be a bunch of money made. It seems to be the case that at the end of any given period of time, profits are taken and trades begin to be reversed. Now, we're not going to look at the Brazilian real in particular, but we are going to look at a bunch of financial instruments. We're going to look at the US dollar, Japanese yen right now. Now, we could be the person on the construction site who wants to lift rocks in their arms and trade every single day and lift a bunch of heavy rocks, and we love it, and we love transporting rocks back and forth. Or we can be the nice lady who pulls up a truck and loads a bunch of rocks and finishes the job in one load. It's totally fine with me if you want to do super active trading every week. It's totally fine. I want to show you today some extraordinary end-of-year trades that will not require very much of your time or effort, and you can just get these trades done without a lot of fanfare or difficulty. The US dollar, Japanese yen has been in an upward trajectory as the US dollar has been strengthened, really by speculation that the US Federal Reserve was going to raise rates. It's been going up now for 2 years, and a bunch of rate hikes have been priced in. This currency pair has also been moving up as the Japanese government has been flooding their financial markets with liquidity. So the Japanese yen has become less valuable, and the US dollar has become more valuable. But that machine is beginning to slow down. The Fed is finally about to raise rates, but we've almost priced in too many rate hikes into this currency pair. We've probably priced in 2 or 3 rate hikes already to the US dollar Japanese yen. There's also another thing that's occurred with the US dollar Japanese yen. Over the last 3 years, we've missed the 2013 yearly pivot wasn't hit, the 2014 yearly pivot wasn't hit, and the 2015 yearly pivot wasn't hit. Additionally, on my chart right now, you'll see some green and purple lines. These are weekly and monthly pivots that were not hit during the week or the month that they were created. I call these missed pivots because they weren't hit in the week or the month that they were created. Missed pivots become magnets for price. They become targets. They become incredibly important because almost every single missed pivot is eventually hit. Almost every single pivot that was missed is hit. And I'm going to repeat this 1,000 times. If you don't know what a pivot is, or if something that I'm saying doesn't make sense to you, go to Google. I don't feel well enough to answer everybody's questions today, and that's not me being mean. You know I love you. I love traders more than anybody in the world. I'm not going to have time to just jump in to answer questions. I want to look at some trades today. Missed pivots. A pivot is a horizontal level of support and resistance that is created from a previous period in time. And if a pivot is not hit in the week, the month, or the year that it was created, it becomes a target. Look at where the US dollar Japanese yen recently went, up to 114. Let's look at this weekly chart here. Guess what 114 was? 114 was the missed 2008 yearly pivot that hadn't been hit because of the financial crisis. And look at how far away the market went from that 2008 pivot during the financial crisis as the Fed was lowering interest rates, keeping them at zero. Even though the Japanese, the Ministry of Finance and the Bank of Japan were flooding the market with liquidity on their own, look at what happened. That yearly pivot was eventually hit. The market returned all the way back up to 114 and above. Look at this missed yearly pivot from 2001. The market was rocketing upwards into the 135s, and eventually it came back down. Now, it took a long time for that to happen, but these missed pivots do get hit again, and we are at a critical turning point right now where the market is turning and where these pivots get hit. So the first trade that I want to talk to you about today is a sell trade on the US dollar Japanese yen. The US dollar Japanese yen has a very strong likelihood of hitting the 2015 yearly pivot, which is located at about 114.33. This is an incredibly reliable profit target, and what you could do to take advantage of this trade is if the US dollar Japanese yen takes another fall into the 118.49 area, you might consider a sell trade down into 114.33, then move to break even, take part of your profit, and even go further. That's trade number one. I'll take a screenshot of this right now, and I will post it inside of the webinar chat area. So inside the right-hand side of your screen in the chat area of this webinar, you will see a chart link come through. And let's move on to another currency pair. A lot of you look at exotic currencies like the US dollar, Mexican peso. In just a couple short weeks, I'm going to teach a class about trading the US dollar, Mexican peso. Me and my crew in the chat room, we trade the Mexican peso every day. I missed it a bunch of days this week just because I wasn't feeling well. It is one of the most reliable currency pairs in the world, and a lot of people are frightened of it because of the spread. And they say things like the spread is too wide or it's too volatile, and they don't know what they're talking about. The spread on the US dollar Mexican peso is 30 to 50 to 100 pips. But each pip is only worth 8 cents. So when you get down to it, the spread on the US dollar Mexican peso, especially during the early session in the morning, isn't really any different than any other major currency pair. The US dollar Mexican peso has been in the same upward trajectory. As oil has fallen and the US dollar has risen, this currency pair has just gone on a wild trajectory. Recently, in August, the Mexican Central Bank announced that they would intervene in the currency markets to the tune of up to $200 million a day to prevent this currency pair from rising any higher. And occasionally you will see sharp pullbacks on this currency pair. This is the same story that we just looked at with the US dollar Japanese yen. The US dollar Mexican peso has moved too far, too fast, for too long, and is ready for a reversal. What's a great target on a reversal? Well, there are all kinds of great targets for a reversal, but one of the best ones is the 2015 yearly pivot. That's way down there, way down there, and this is a giant, giant trade. If this currency pair begins to fall, we are going to execute or turn on a huge trade. And I would recommend that that would come below 16.35. So let's just say 16.35. Sell. The target on this can be thousands and thousands of pips. And there are weekly and monthly pivots that have been missed. And there has been and is a 2015 yearly pivot all the way down there. There are great targets on this, and this is just an amazing trade that no one is looking at. No one is looking at this trade at all. This currency pair is a forgotten currency pair that no one looks at because they're afraid of it and they don't understand it and they don't understand the spread. But if it breaks 16.35, this is going to be a strong, hefty, significant move lower. In my family of traders, many of us use a robot just to take this trade automatically so that we don't even have to look at it or be present in front of the charts. This is the US dollar Norwegian krone. Once again, I'm not here to tell you about what everybody else is looking at. I'm here to show you and look at trades and opportunities that maybe no one else in the world would show you. I'm pretty sure that no one's going to show you the US dollar Norwegian krone. Okay, so we've got the same situation setting up right here. We've got a yearly pivot down here that hasn't yet been hit, and we've got a great setup. Look, when you have all these missed weekly and monthly pivots, something has to change, and eventually this turns around and we get a reversal, and no one's expecting it anymore, and it will come. So on a break below this trend line on the weekly chart, we could have a significant, gigantic move lower, and I will post this chart inside of the webinar software as well. So you can take a look at that, you can save it, and you can look at it, and you can play with it later on. Now, if you're wondering if we're going to look at stocks, yeah, we're going to look at a few stocks and ETFs as well. We're not just going to look at currencies. I do specialize in currencies, but we're going to look at stocks as well. This is the Australian dollar, US dollar. It's been in a free fall for what seems like forever. Since 2013, it's lost a significant amount of its value, but it's finally gone divergent. At the bottom of the screen, you can see a red line underneath the candles. That's Knoxville divergence. I don't have time to describe that today, but if you get on the email list, you'll eventually receive an invitation to download those indicators for free. In fact, you could even go to kajabinext.com, and then let me log out here. I have a free course on kajabinext.com, and you just go to kajabinext.com, and what you do is you search for Rob Booker or Trifecta, and you will find a free course that gives you my indicators on Kajabi Next, and you just have to go in there and you have to probably have to sign up as a student or whatever, and then you can search for the courses. Let's see here, Kajabi Next. Anyway, you get on my email list, you'll get the same thing. All right, this is the Australian dollar, US dollar weekly chart. We've been moving down forever, and that eventually is going to stop. The yearly pivot is up here at 85.85. We're 1,500 pips lower than that. If we break this trend line upward, we are very likely to have a significant move upward in the Australian dollar. The problem for the Australian dollar is that the Chinese economy has been slowing, and investors are worried that that will have a significant negative effect on the Australian dollar. Much of that, however, in the currency market gets priced in before the news actually hits. The Australian dollar has been falling on that worry of China for quite some time. And so sometimes you get the anticipation move like we've seen right here with this currency pair, and then we start to turn around before anybody realizes why. At the end of the year, September, October, November, December, we are likely to see a reversal back upward in the Australian dollar, US dollar, if it breaks this trend line and moves up. So I'll post this one in here as well. And I'll get you a solid link to that indicator course on Kajabi Next in a minute. Let's look at something a little bit different, like the Euro British Pound. Here's the Euro British Pound breaking through a trend line, divergent here at the bottom, and we've got a yearly pivot for 2015 up there at about 8,000. It's pretty crazy. There's a lot of movement available in this currency pair. It looks like the euro might make a little bit of a resurgent move against the British pound. It looks like that might happen, or it looks like it might have already occurred. If it continues to move up, that's a dumb trend line there. I'm going to remove that trend line. If it continues to move up, it's probably going to hit that missed monthly pivot at 75.88. Draw a line across these tops, and a move above 74.30 could bring us to 7,600. So 74.45 buy. Let me make sure I got that one right. Yeah, I got that right. And then a reasonably easy target for this would be a missed monthly pivot from way back in February of this year. I'll take a snapshot of this and hand it over to you. All right, everybody having a good time? Hi, Chris. Nice to see you. Am I going to discuss single stocks too? Yeah, is everybody having a good time? Nice to see all of you here. How about you? Andre, Angel, Armand, Bonder, Beverly, Douglas, Henrietta, Ida. How's everybody doing? Okay, great. It's always good to get a little bit of feedback during. Thanks, Mark. Thanks, Usinger. Nice to see you here. It's great to have you along for the ride. Awesome. Great to hear from you. All right, let's look at a couple other ones. Let's look at some British pound stuff. British pound, US dollar. Already got a big move here this year, you can see. We've already really had a resurgent move back upward in the British pound. There's a lot of speculation that now Britain, the UK, or the Bank of England might be the first to raise rates, or is going to be right on the heels of the United States. They traditionally have raised interest rates faster than other central banks. And if we break this trend line upward, then we are very likely to see a wonderful move up to the yearly pivot. So I would say a move to 1.50, let's see, above, I would say above 5,700. And a target of the yearly pivot. Same thing, likely to happen at the end of the year. And a wonderful long-term trade that doesn't take very long to plan and is worth a ton when the trade fires off. All right, I haven't really looked at stocks this week much at all, but let's take a look at Tesla, and we'll take a look at some other tech stocks. So Tesla's already hit the 2015 yearly pivot, but you can see Tesla kind of plateauing here. There's a lot of concern right now that technology stocks are overvalued. I read today in the New York Times that there are 120, and many of them are venture-backed, companies that sell snacks by subscription. That is ridiculous. That is ridiculous and stupid. That is way too many companies selling snacks through the mail. If Tesla reverses or comes back down, Tesla has a long, long way to fall. Technology stocks in general fall into that category. What we're looking at right here is an example of what I call Class A divergence. And I'm going to teach you what this means right now. It's very simple. What we have here at the top are divergence lines. They're called Knoxville divergence, and as I mentioned, that's an indicator that I built and that I use, and it demonstrates or shows that price may be ready for a reversal in the opposite direction. And then we moved sideways after we formed that divergence. If we form divergence and move sideways, I call that Class A, because what's about to happen in general, or typically, is that we are about to form a giant move lower, which turns the whole formation in kind of an A shape. And the middle line on the letter A is a horizontal level of support below which we sell. Below 181, Tesla is a very high probability sell trade. Now, you're only going to get this trade one time, and it could take 2 months to occur. But if it does this, this could be a giant trade with a target down at 105. And what this would suppose is that we have a giant sell-off in technology stocks, and Tesla hit. If this happens, this is an extraordinarily high probability trade, super high probability trade. And you simply place the stop loss up above a recent high before the break and a profit target down here, so you have a great risk to reward ratio, and that looks absolutely brilliant. Here's Facebook. Facebook has been a rocket ship up toward $100. I don't think it ever hit $100 a share, which I thought was pretty interesting. Never quite hit that level. But Facebook is sort of in the same situation that Tesla would be in, that we saw this deep correction that maybe worried some and maybe didn't worry people enough. We had some divergence previously, and we may make a new high. And if we make a new high, it would be my guess that we are going to go divergent on the weekly chart on Facebook. And if Facebook makes a new high and is divergent, I am going to set up a sell trade on Facebook down below some of these recent pivots and sell down to, even as far down as like $48 a share if things really get difficult. I would even set up in my account a pending order to sell Facebook below 83 if things really start to get hairy. I'd love to sell it earlier if it forms divergence up at the top, right up there, way up there at the top. Let's go back to Tesla. I'll take a screenshot of that, and I'll put that inside the webinar software so that you can all take a look at that on your own time later on. These are all trades that don't require you to watch the screens constantly. They're all trades that you could do just looking at the charts maybe once a day. You don't have to look at the charts, all the time. Twitter is probably one of the worst technology stocks of them all, but Twitter's probably going to get bought by some other company, Microsoft or Apple, or somebody's going to buy Twitter. it's just very unlikely to survive on its own. I think that's one reason that Jack Dorsey could remain as CEO of Twitter while Square goes public. I just don't think Twitter is going to be its own private entity for very much longer. It's begun to lose value. It's been dipping into the 20s. It's below its IPO price. Twitter's got some significant problems. It's got management problems. It's got user retention problems. There's speculation that the advertising model really isn't working as well, and some of the advertising dollars they're making come from bots and whatever else. And I would say that, you know, the move on Twitter to look for is a move above that trend line there. If we first form some divergence down below, we could check the one-day chart and see if there's any divergence on the daily. Not really. But if we move above that trend line on rumors of or on actual merger talks or whatever, we could see a move into the mid-30s on Twitter. Only if it's a takeover target. And I think the odds are incredibly good that Twitter will be a target for Apple, Microsoft. Yahoo's going to, you know, I wouldn't be surprised if Yahoo made an attempt. I just don't think that that's likely to happen. I think Twitter's market cap right now, I think we could see it right here on the side of the screen here, is $17 billion. It's not a $17 billion company, but if a company came along and offered $20 billion, $22 billion for it, they would take it. It's shocking to think that Twitter has now got a market cap that is less than what was paid for WhatsApp. Is that correct? If I remember correctly, WhatsApp was like 19 billion. Is that even true? Can that even be real? Oh my gosh, it was, wasn't it? That's so stupid. That's ridiculous. That's the dumbest thing I ever heard. Okay, anyway, enough of me, you know, just whining and whatever. Let's look at Groupon for just a second. I like Groupon. I don't have anything. I don't have anything against this company, but Groupon's in a real decline. Same thing here. Maybe to go to the one-day chart, you could see this just incredible decline in Groupon, but we've started to print some divergence. Groupon's only got a market cap of $2 billion and has a bunch of customers. And as price continues to fall, Groupon is another one of these perhaps good-looking takeover targets, and it's got a ton of delicious missed pivots here. So watch for Groupon to break this trend line here, and at the end of the year, make a surprising move upward. It would be very fast. It would be a really quick move if it happened at all on something like that. Okay, I'm going to look at just a couple other things like the SPY. We'll look at the S&P 500, and we're going to look at the weekly. When looking at an end-of-year trade here, the real trade that I see is that we've missed a bunch of yearly pivots. The 2014 yearly pivots at 171, and we have begun to form Class A divergence. Divergence, sideways movement, a horizontal level of support, and then a possible move lower. This could be a really good-looking sell trade right there. That could be something super extraordinary. And I know it sounds crazy because we're at 192 right now, but below 181, sell the heck out of this and target that 2014 yearly pivot at 171, or go all the way down to that missed monthly pivot at 160. I'll take a snapshot of this chart right here and pop it in the window here. Okay, I'm going to stop sharing my screen for just 1 second. Stick with me here. And I'm going to get you, there we go. I'm going to pull up a link here for my indicator package on Kajabi Next. It's a platform where get the indicators that I showed you here. So that's a link inside the webinar software where you can get my indicators, and that will walk you through the process for downloading the indicator packages for MetaTrader, eSignal, Forex Tester, FXCM Trading Station 2, MotiveWave, MultiCharts, NinjaTrader, Thinkorswim, TradeStation, and even Sierra Charts. And that is a free course on Kajabi Next, and you will be introduced to other courses that I teach on here that in some cases cost money. I'd be very happy to hear from you, and I hope that you'll stay in touch with me. Thanks for spending some time with me. Stay in touch. I'm at robbooker.com. My name is Rob. I love traders. Thanks for joining me today. And thank you to Reed and all the folks over there for having me over today. Bye for now.